At 24, Jason thought compound interest was just one of those boring finance phrases people repeated to sound smart. He had heard it in school, heard it online, heard older people talk about it like it was some magical secret. Start early, let it compound, your money makes money. It all sounded nice, but none of it felt real. Because at 24, real life didn't look like compound interest. Real life looked like rent, student loans, rising grocery bills, a paycheck that disappeared too fast, and the constant feeling that there was never enough left over to build anything meaningful. Compound interest sounded like advice for people who already had money, not for someone trying to survive their 20s. So Jason ignored it. Not aggressively, not irresponsibly, he just treated it like background noise, something he'd focus on later when he made more money, had fewer bills, and felt more financially stable. That's how most people delay the most important financial advantage they'll ever have. Not because they're careless, because it doesn't feel urgent. That's what makes compound interest so psychologically dangerous in the beginning. It asks you to respect something before it feels real. It demands patience before there's visible reward. And most people are wired to respond to what feels immediate, not what grows quietly in the background. At 24, Jason's friend Eric started investing anyway. Nothing dramatic, a few $100s a month, no big salary, no secret strategy, just consistency. Jason thought it was pointless. The account barely moved. Some months it went up, some months it dropped, and the total still looked too small to matter. That's the phase where almost everyone loses interest, because early compound interest is invisible. It feels slow. It feels underwhelming. It feels like effort with no emotional payoff. And that's exactly why most people never benefit from it. Jason kept waiting for a better time, a higher income, a cleaner financial situation, more certainty. But compound interest doesn't reward perfect timing. It rewards time. That's the whole game. And by the time Jason hit 30, the difference between him and Eric wasn't massive yet, but it was visible. Eric had built momentum. Jason still felt like he was trying to begin. That's the first level of compound interest. It doesn't make you rich. It makes starting easier later, or harder if you delay. And that's the part nobody explains well. The first stage of compounding isn't about growth. It's about building the base that growth eventually depends on. At this stage, the real return isn't money. It's behavior, discipline, consistency, repetition, identity. Because long before compound interest changes your bank account, it changes your habits. And habits are what determine whether money compounds at all. Jason thought he was postponing investing. What he was really postponing was momentum. If you're watching this in your 20s or even your 30s and compounding still feels too small to matter, that's exactly why this matters more than you think. Make sure you like, subscribe, and join DollarNeck, because in the next part, we're breaking down what compound interest actually feels like once it stops being invisible and starts changing your life.
By 33, Jason finally started taking money seriously, but not because he suddenly became passionate about investing. He started because life got louder. Rent was higher, responsibilities were heavier, and the margin for financial mistakes felt smaller. He was earning more than he did at 24, but somehow money still felt tighter than it should. That's when he finally looked at what Eric had built. And for the first time, compound interest stopped sounding theoretical. Eric wasn't rich. That's what surprised Jason the most. He wasn't driving anything flashy, he wasn't posting luxury vacations, and he didn't look financially different on the surface. But underneath, his money had started doing something Jason's money still wasn't doing. It had momentum. That's the second level of compound interest, and this is where it starts becoming psychologically real. In the first stage, your money barely moves, so everything depends on discipline. In the second stage, your money starts participating, not enough to replace your effort, but enough to finally be noticed. That changes everything. Because now, growth doesn't only come from what you contribute, it also comes from what already exists. Eric was still investing consistently, but now the gains were no longer invisible. A decent year in the market added thousands, not because he suddenly became smarter, but because the base was large enough for small percentages to matter. That's the moment compounding starts feeling less like effort and more like momentum. And psychologically, that shift is huge, because this is the stage where people finally understand what patience was buying. Jason noticed something else too. Eric made calmer decisions. He wasn't constantly stressed about every expense, every paycheck, every small disruption, not because he had unlimited money, but because he had built margin. His money had started creating stability in the background. That's one of the most underrated effects of compound interest. Before it creates freedom, it creates breathing room. And breathing room changes behavior. It makes you less desperate, less reactive, less likely to make bad financial decisions under pressure. Jason realized that most people think compounding is only about growing wealth, but before it does that, it changes your emotional relationship with money. You stop feeling like every financial decision is urgent. You stop operating from survival. And that psychological shift matters just as much as the math. This is also the stage where many people make a mistake. They finally see progress, and because the numbers start looking meaningful, they become impatient. They want to speed it up. They take bigger risks, chase faster returns, try to force the process. That usually backfires, because the second level of compound interest is where patience becomes hardest. Now it's working, but not fast enough to feel finished, and that's where discipline still matters. Eric understood that this stage wasn't about acceleration, it was about protection. Protecting the habits, protecting the consistency, protecting the system that was finally starting to work. Jason finally understood what he missed in his 20s. The early years weren't supposed to feel exciting. They were supposed to build this, the stage where money finally starts helping. If you're in this phase right now, where your investments are no longer tiny but not yet life-changing, this is the most important stretch to stay consistent, because this is where compounding stops being invisible and starts becoming real.
By 42, Jason finally understood why people who truly understand money stop talking about it like it's exciting. Because at the highest level of compound interest, money becomes less dramatic and more powerful. It stops feeling like something you constantly manage and starts feeling like something quietly working in the background. That's the third level of compound interest, and this is where life actually begins to change. By this point, Eric's portfolio wasn't just growing because he was adding money, it was growing because the base had become large enough to move on its own. He was still contributing, still consistent, still disciplined, but now his effort was no longer the main driver. His money had started doing more work than he was. That's the moment compound interest becomes life-changing. Not because you suddenly feel rich, because you stop feeling financially fragile, and that difference changes everything. Eric still worked, he still earned, he still planned carefully, but the pressure underneath his life had changed. A bad month didn't feel like a crisis, a job shift didn't feel like a threat. Unexpected costs no longer had the same emotional weight because he had built something most people never do: financial margin backed by momentum. That's what the final level of compounding gives you, not just more money, more control. And control is the real luxury most people are actually chasing. By this stage, Eric wasn't making emotional decisions with money anymore. He didn't need to chase fast returns, react to every market headline, or obsess over every small financial move. The system was already working. His job was no longer to force growth, it was to avoid interrupting it. That's the final psychological shift compound interest creates. At the first level, money feels small and effort feels heavy. At the second level, money starts helping. At the third level, money starts carrying weight. And once that happens, your entire relationship with work, time, and risk begins to change. That's when people stop staying in jobs purely out of fear. That's when they stop tolerating financial pressure just because they have no cushion. That's when decisions become less about survival and more about choice.
And that is what compound interest was doing the entire time. Not just building wealth, building options. That's the part most people misunderstand. They think compounding is about becoming rich one day, but the real value shows up much earlier and much deeper than that. It shows up in reduced stress, in flexibility, in patience, in not needing every decision to work perfectly because your financial life is no longer fragile. Eric looked back and realized the biggest lie he believed in his 20s was that compounding was too slow to matter. In reality, it was slow because that's what made it powerful. The slow years build the base builds momentum, the momentum builds freedom. That's the real progression, and almost nobody experiences the final stage because most people quit in the first. So if you're early, stay consistent. If you're in the middle, stay patient. And if you're far enough in to feel momentum, protect it. Because compound interest is not just changing your money, it's changing the amount of control you have over your life.
If this video opened your eyes, make sure you subscribe, because what you learn today can save your future tomorrow.